Hey, it's Ty with Credit Suite, and in this video, I want to talk to you about financial stress scores and what you need to know and how lenders and credit issuers gauge your risk of filing bankruptcy or closing your doors, and how you can be gauged as a high risk and it's preventing you from getting the money you need right now. Most importantly, I'm going to teach you how to fix it. So every credit bureau, Experian, Equifax, and Dun Bradstreet in the commercial world have some variant of what's called a financial stress score. And these scores are used to literally depict your risk of going out of business in the next 12 months, closing your door, filing bankruptcy, ceasing operations, whatever you want to call it. All three of the bureaus have a score to gauge your risk of this actually happening over the next 12 months. Now, each bureau calculates different things into the score to determine how high of a risk you are of actually filing bankruptcy. But obvious things like how you pay your bills, how much you currently are on time or off time, and your current utilization calculated into these scores. But here's where things become really problematic. Credit bureaus like Experian and Equifax will give you a failing credit score. I mean, like 6 out of 100, with 100 being the best score you get and 0 being the worst, even when you have no credit. And here's how it works. If you don't have any credit on your business credit reports, if they can't look to see if you have collections and judgments, they can't look to see your payment history, they can't look to see how positive or negative your accounts are, then what they do is they start looking at other factors to determine the financial stability of your business. And these factors are things that you would not expect that they are. Number one, they are the number of employees you have. That's right. They gauge your ability to function and not file bankruptcy based on the number of employees you have. The fewer employees, the greater risk you are of going out of business. I know, it's absurd. It's crazy, but it's how all of their scores work. This is why you need to be so aware when you're filing that annual report with your Secretary of State and they ask the number of employees you have. It seems so minuscule, but I can tell you that a lot of the commercial credit scores that are used in the commercial credit scoring world take into account the number of employees you have in lieu of having financials, in lieu of having credit history. When they don't have these things, they rely on things like the number of employees you have. If you're a bigger business, they see you as less risk of actually filing bankruptcy and you get a higher score. But if you're a startup, if you're a new business, and you have few employees, then you are a very high risk of potentially filing bankruptcy, and your score will be very low even when you have no credit on your business credit reports. It's one of the biggest restrictions I see that hold people back from getting the money they need. They don't build their business credit. Their business credit scores are bad because they're just getting their business off the ground. They have no credit history, and the bureaus are using things like number of employees to determine the financial worth of that business. So be careful when you're filing out or filling out that number when you file your annual reports, and know how it's being used. Another factor that tallies into this is beyond the number of employees you have. It's the NAICS code that you have chosen. Yes, it's a really big deal. So NAICS code is the industry code that you have. And I can tell you this, over 70% of the credit scores used in the commercial credit world take into account your industry. They will actually gauge your risk against other people in your industry. They will give you failing scores if they don't like your industry. And I've seen industries like dance studios be high risk and get failing scores with the credit bureaus. I have no idea why a dance studio is high risk. No clue. Maybe Experian will tell us someday, but I see it happen all the time. People are issued failing scores, and the reason is because they don't like the industry sector. They don't like the industry at all. So here's a question for you. Do you know your NAICS code? Most don't, and this is why you need to. You choose your NAICS code. You can go to a place like NAICScode.com and find the right NAICS code for your business, the one that more specifically fits your actual business type. Once you've done so, whenever you fill out an application for loan or an application for a credit card or credit line, you need to insert that industry with the actual code. So if you're a software service, you want to put exactly what that is and the actual number of the code. This way, all lenders and credit issuers are putting you in the correct NAICS code. If you just say software, for example, you got problems because there are like 15 subcategories of software. So if you just put software as your industry, the lender or credit issuer is going to decide which of those 15 subcategories you are, and that's your NAICS code. Now multiple problems start to occur. Multiple NAICS codes start to appear on your credit reports, and then your risk is being judged based on you being in all these industries, many of which are high risk. So you control your NAICS code. Figure out what it is, put it on your tax returns when you file taxes, dispute with the credit bureaus to make sure they have the correct one, and moving forward, on your loan applications, on your credit applications, make sure you enter the name of your NAICS and the actual code itself so nobody can be confused of the actual category of business that you are in. And doing so, this will give you the best chance of overcoming high-risk industry lower scores that come from them not liking your industries or the credit bureaus. Actually, it's the second best way. The first best way is build your business credit. Okay, you're issued failing credit scores from places like Experian and Equifax because they don't have any information about your business. If you haven't built your business credit, they don't see your positive payments. They don't see your positive trade experiences, and they use negative stuff like not liking your industry or not having a lot of employees to actually give you failing scores that infects your ability to get the money you need and drastically get you to a point where you're getting less money than you want and paying way higher interest rates than you should pay. It's easy to control. It's just about building your business credit. And by building your business credit, you can get around things like having fewer employees. You can get around things like the bureaus not liking your NAICS because you lower your risk because you show that you're responsible in your business and pay your bills on time. So that's some advice to make sure that you can get around these things. These financial stability scores show that you are going to file bankruptcy and will absolutely be low if you don't control things like your business credit quality and they revert to your NAICS codes and number of employees. Now you know how to fix it. And for more information on improving your fundability and building your business credit, visit us online at creditsuite.com/EIN. creditsuite.com/EIN for our step-by-step guide on building your business credit and improving your fundability. Thanks. Have a great day.